Hello traders, it's Monday, August 30th, 2010. Woo! Markets come crashing down. 3 digits here on the Dow, down 1.4%. The S&P down 1.5%. The same goes for the NASDAQ. Russell's down almost 2.5%. That is ginormous of a drop in the market. The VIX, major spike over 11%, putting us above 27. After market hours, we continue the slide on the futures heading south. Gold also down, but the trend, wow, for those that are day traders that know market internals, we spiked up, closing at 3.55, which is out of this world. Huge chance of us starting the markets up tomorrow. But let's look at the technicals here on the S&P daily. We closed at the day's low. You can see this, no lower shadow, very bearish. We have ourselves what looks to be a bearish Harami reversal pattern, but the problem is we never did get an up leg, so you can't call that. All we have is consolidation. We go down, we go up, we go down, we go up, we go down. I mean, it's just choppy market. And what we are developing is what's called a low base. Doesn't surprise us because we as technicians know how to read these trend lines and whatnot. I've been showing this for some time now, and the power of it is just huge. But what you have is this big swing low, March of 2009, and we marched this right back here to the lows here in late June, early July. And then we march up and we crack through that. Now that's acting as resistance. We have this trend line coming down acting as resistance, and a major other trend line coming across acting as resistance. So there's a lot of resistance here. So it's going to be a tough area to get through. I tried to share that in the weekend's video, and I hope you paid special attention to it. But I said people were getting all excited about this big rally, the short covering that was taking place on Friday. But I said we're at major resistance. Don't be surprised if we don't just head right back down. That's precisely what has happened. So in consolidation is a good chance and a good time to be sitting on your hands in the markets. And until you get either a breakout or a breakdown. But right now, everything is pointing to the south. I think that we're set up for a major drop to the downside, but I will believe it when I see it. That's the thing with us in the trading world. We need to start thinking like trading experts and not like trading amateurs, and trade exactly what it is that you see. If you find yourself losing money out there in the markets, the thing that you want to do is think capital preservation, because capital preservation comes before making money in the markets. A lot of people and students, when they come to us, one of the places that they are mentally is that they're down money, and then emotions are running wild. So what happens is they try to make a lot of their money back quick, and that's actually the worst thing to do. You have to first stop the bleeding, and then you have to put rules and in place, but they have to be key rules. They have to be rules that actually increase your probabilities in trading. And once you have been able to quantify that those rules increase your probability with a byproduct of profitability, once you've quantified them, then you can really latch on to them. Now you have a stance. Now you have something that's got some teeth behind it. And at that point you were set. But what I'm saying is this: it's better to sit on your hands than it is to gamble. It's better to take baby steps and to trade lesser shares or contracts than it is to leverage up, hoping to make your money back. So just a little tidbit. That's me putting on the mentor hat. That's me taking you under my wing because I care. Because every dollar is an employee. Those employees have to be making us money, not losing us money. So mind your employees, mind your money, mind those investments, and make sure you're making the best absolute trading decisions you can be making out there. Take care, and happy education to each and every one of you.